Greetings, and welcome back to the Rose Bros podcast. This episode, we are joined by Mr. Robert Colcleugh, CEO of Tidewater Midstream and Tidewater Renewables, two energy companies listed on the Toronto Stock Exchange with a market cap of approximately $400 million and $260 million, respectively. Mr. Colcleugh is also the chairman of the board of Beyond Energy Services, a managed pressure drilling service company since August 2017. Mr. Colcleugh was the CEO of Ironbridge Resources until its sale in October 2018 and was also a managing director of investment banking at Macquarie Capital Markets. Mr. Colcleugh was also one of the founders of Tristone Capital, a global energy investment banking boutique that was purchased by Macquarie in 2009. Mr. Colcleugh obtained his Bachelor of Arts in Economics from the University of Western Ontario and graduated from the University of Western Ontario's Ivey Business School with an MBA in 1997. Among other things, we sat down and discussed investment banking, entrepreneurship, and Canada's first renewable diesel plant. Enjoy. This podcast episode is sponsored by Conate Water Solutions. Do you need cost-effective water sourcing options to supply your next drilling or completions program? Conate Water Solutions is a specialized hydrogeology company focused on water well drilling, testing, and water management services in Western Canada and Texas. Contact info@conatewater.com or check out conatewater.com for more details. This episode is brought to you by Canada Action, whose aim is to promote the importance of Canada's energy industry, which is the bedrock of our nation's economy, providing hundreds of thousands of jobs and economic opportunities across the country. Learn more at canadaaction.ca or check out Canada Action on social media. This podcast is sponsored by headracingcanada.com. Looking for high-performance ski gear this winter? In partnership with four-time Olympian Manny Osborne Parody, headracingcanada.com is offering the lowest prices possible through its online storefront by passing brick-and-mortar savings on to customers. Check out headracingcanada.com for more info and get your high-performance ski gear for the upcoming season. Well, if you're ready, we can start.
Sure.
Good morning, Mr. Robert Colcleugh.
Good morning. Thanks, Trevor.
Thank you very much for doing this.
Happy to be here.
I guess for the listener, you are the CEO of Tidewater Midstream.
Yes, and Tidewater Renewables, two public companies.
What is Tidewater Midstream and Tidewater Renewables?
Sure. Midstream was started about 6 to 7 years ago. We're like many of our larger competitors. We've got a variety of midstream assets, mostly gas plants, pipelines, some fracs, but also we have a refinery in Prince George. So that differentiates us a little bit. That's the midstream business. And then the renewables business, we spun that out of the midstream business 2 years ago. The major asset in that company right now is the HDRD, which will be Canada's first renewable diesel plant. And that'll be online, actually, we expect this week.
To back up a little bit, how did you get into energy?
That goes back to Toronto. So I hail from the East and came out in 98. So I've been here for quite a while. But at that point in time, I had graduated from business school and had joined a merchant bank, which was kind of a little bit of the flavor of the day back then. And anyway, the company that I ended up going to ended up not raising that merchant bank, and they had a variety of other funds, and I ended up getting tasked with running a junk bond fund, which actually is still up and running. But so I learned that business, which actually is quite interesting. I still actually use some of the things that I learned in that 2-year period. But once that fund got placed, they had some spare capacity and they put me on an oil and gas fund. And so I had zero understanding of oil and gas, wasn't 100% sure that the gas part of oil and gas wasn't gasoline. So yeah, I was a real newbie. It was really trial by fire. But again, it was kind of exciting because we were learning on the job, and I would have, at that point in time, I was replacing a guy who had left. So I didn't have a lot of advisors or people to learn from. I kind of learned from the oil and gas companies that would come through on road shows. So I met a lot of guys that I still know today. A bunch are still running companies as they were back in 98, 99. And it was a very tough time in the patch at that point in time. So it was actually quite interesting to meet, and emotions were running really high. Companies were on the edge of survival. It was a really, really tough time. And so that was a really interesting nuance to it. I mean, this is like an onion in our business, right? I mean, I still learn every day in a variety of different aspects. But so there was the learning aspects and the technical need to understand at least the basics that takes a bunch of time. But then the personal side of it was, I really got exposed to that, as opposed to today. It's great. And an investor may come in and meet with the CEO and get the story and move on. And, it's really all about the story. When I was doing that, and I'd come out here and meet with companies, I mean, there were guys who were losing their livelihoods. Their companies were getting rid of half of their staff. I mean, I did have guys crying that I would meet for the first time as we're going through their story. So, it added a real dimension to, the oil and gas business, and it helped me to dig in further. And so anyway, I did that for a number of years, made the decision. I had actually met my wife currently, back then, I guess it was my girlfriend, was living in Edmonton, and we both decided to move to Calgary. And I ended up getting a job out here with Duke Energy, these were the sort of heady days of Enron, and we were all trading large volumes and dollars worth of natural gas and power contracts, and it was quite a lot of fun. Anyway, they needed somebody who understood the equity side of the world. We had a very large balance sheet, being a giant U.S. utility, and we could deploy that up here. So it was very interesting, because it wasn't a job that I was filling. It was like, here's the situation. What can you do with this? And again, I was able to go out and deal with oil and gas companies, generally smaller ones, call them mid-cap today, to small companies who were looking at ways of creatively financing or creating, interesting hedge structures, and anything around the commodity is what we were focused on. So that's what brought me out to Calgary, and that's what really got me into the oil and gas business in a big way.
You've had a lot of experience in the trading side, banking side, but also on the business side, the operations side. So I thought maybe today we could structure the conversation around those kind of two halves.
Yeah.
Get your thoughts on all that. As a non-technical person in a technical business, what do you think helped you along the way? Did you kind of pick up the technical along the way? How were you able to lead companies?
I find this business like an onion. It's quite interesting to learn every aspect. I mean, it's from a downhole tool. I was running a service company, which I still do. I'm only on the board of it now. That's a pressure company, for example. We started that in 2016. I had very little exposure to the service side of the business. When we started Tristone in 2002, we were predominantly focused on E&P, and so really didn't have a lot of that exposure. But I think for me, I like learning. I like learning from people that I think are good at something and figuring out why they're good at it, and the technical side of it. It's interesting. I don't want to pretend, and I'm always catch myself. You can be an inch deep and a mile wide. You really do still have to rely on people who are experts and spend all of their time doing that. But, the decisions that I have to make are around risk and dollars and cents, and understanding just how risky something is, and understanding how that's going to translate into dollars and cents. And so you have to know, you can't be in oil and gas and not have some technical understanding. For me, it comes pretty easily because I enjoy it.
One of the main jobs of chairman or CEO is capital allocation. Did you view it from that perspective? Do you think maybe that was one of your strengths?
Yeah, that's, like I say, that's sort of where the rubber hits the road. Understanding how risky something is, and understanding how it hits your bottom line, and whether you're going to, as you say, allocate capital to it. Those are the fundamentals. And sort of we all have different guiding lights, and mine is definitely creating shareholder value and understanding what the returns are of the dollars that you put into something.
Maybe to get back to the banking side a little bit, I've always been interested in the entrepreneurship side of investment banking. What was Tristone Capital?
Yeah, the genesis there was to take a bunch of senior people around town, pluck them out of a variety of different, often banks that they were working for, and bring everybody together in a boutique way. Use our own capital to the extent we could. Obviously, that gets challenging when you're doing bought deals, which is a Canadian concept more than an American one, but requires that capital. So we had to do some fancy footwork at times, especially in the beginning. But it was that was the genesis of it, was to bring people with senior amount of experience pretty much across the board, from banking through to the capital markets side of things, research, sales, and trading. And then also bring a technical bent when it came to asset sales. So now, you'll see everybody has a asset sale business. Every bank has one, and every boutique, and even, some of the smaller guys are focused entirely on it. That was pretty new. It was Watrous that owned that market back when we started, and which was Adam Watrous, who has Strathcona now. And I would say they had 87% of the market before we came along, and we brought in a bunch of technical people. And the idea was, look, when everybody's looking at an oil and gas property, and that was 95% of what we sold in that part of the business, everybody does the same 90% of the work. So why have every company come in and have your engineers and geologists work up the basics, right? All of your PDPs, or maybe even your provens, and everybody's going to get to pretty much the same number. Everybody knows what the basics are worth. And it's that last 10% that really differentiates a bid. Somebody who, it fits strategically with, or somebody who believes in the upside. Let's say back in the day, we used to say probables. Nobody even talks about probables anymore because it's more like a manufacturing operation. But back in the day, it was exploration. You were looking for new conventional trap pools. In any event, that we thought we would save people a lot of time that way. And a lot of, a well-run company is going to, if they're going to evaluate something, they're going to take their time and spend a lot of resource time doing it. For us, we thought we could help people to come up with that basic starting point, and then figure out whether they really wanted the property because they believed in the play types, or again, like I said, to fit. There's some strategic fit with their own organization. So it worked. I think it worked for people, and they liked dealing with our technical staff. They could get comfortable. Okay, yeah, I would have done the same thing. Let's focus on the last bit. So that was kind of the genesis, and it worked because we were very quickly split the market with Watrous.
Mm-hmm. But at the same time, there was Peters & Co., there was First Energy, there was Watrous, maybe others, if I'm forgetting anybody, but did you guys spot a hole in the market or a niche? What made you different?
Yeah, well, the technical, and nobody was doing A&D. It was only Watrous was. So nobody's selling, producing properties by themselves at any of the investment banks or any of the banks proper. In fact, they all, when asked about it, they'd all say, "Oh, it's a conflict." We never were quite sure where that conflict existed. And obviously every single one of them does it now. So it wasn't really a conflict, but they'd left that market to Watrous. So that was our fulcrum that we could apply. That got us in the door with a number of larger players that we wouldn't have had a hope of getting in front of, from the North Rocks to the Suncors and everybody, Devon. All of a sudden we could sell producing properties. And so it gave us an entree into those larger companies that would really only deal with banks, or maybe Peters & Co., because they've got historic relationships there.
How did you pay the bills when you were getting going?
It was really skinny. Yeah, everybody wrote checks. There were one or two of the guys who had made passes. George Gosby was the CEO and instigator behind the whole thing. He'd made a little bit of dough. one or two other guys, but the rest of us had all went to the bank. And actually, that's probably one of the best things that George was able to do for us was, I won't say which bank, but was able to get a personal banking relationship with our whole firm. So we all en masse went to one place, and they lent us way more money than they ever should have. I know in my case, I had no reason to expect there to be enough collateral for the loan. So we all levered up a lot, and it was a real leap of faith.
Sometimes banking is kind of who you know. You just had to get the first deal. Do you remember your first big deal that maybe helped a company take off?
Yes. The first asset deal, it wasn't mine, so that's why I struggle a little bit, but the first asset deal we got was really important. It really gave us a few months of running room, and it was a North Rock deal. We had some support there internally, and it really made a big difference. So we got an asset package from them in the greater scheme of things, and I couldn't even tell you where it was. It wasn't large, but it provided enough breathing room that we could survive for a little bit. And by the time we'd closed on that first one, the A&D team had another, and we were hitting the phones hard and meeting with people in town, and again, trying to bring a bit more of a technical bent to not just the investment banking side, but also the capital market side, and sort of bring a little more technical heft to some of the research that we provided, as well as, who was phoning people up.
I've had a few investment bankers on the podcast before, and I'm always interested in what makes a good investment banker. Is that last 10%, in a way, the intangibles that separate?
I think there's a few things, and it's probably not any different than any other job. I saw the benefit. I've seen guys who have been good bankers and who have been bad bankers. And sometimes it's the environment that you're thrown into. The boutiques are challenging. The guys who do a good job on the relationship management side tend to be the banks, because they've got the time. They don't have anybody breathing down their neck. They don't have to worry about covering the rent or covering the losses on the sales and trading desk. They can develop those relationships and have them for a number of years. And that's, I think, the larger companies definitely appreciate that. They're making decisions that are multi-billion-dollar decisions. And, they're not going to go with the guy who comes in 25 basis points cheaper or, came up with an interesting idea at breakfast that morning. It's a long-term relationship driving thing. It doesn't change when you're at a boutique. You have to maintain your relationships, but there is an urgency in terms of generating money. That churning of transactions is really important. So we have more smaller deals typically call it a boutique. And by boutique, I mean all the way into the mid-market. I'm just not the bank size. So you kind of have to kick a lot of deals, and you got to be pumping them out. I don't know how these guys have been surviving the last few years, because that business is completely dried up. It's your underwriting fees that, provide the lift and cover the rent and cover, frankly, your sales and trading costs, which are, generally a loss leader. So, I think there's the relationship management, if you will, is important. A little harder when you're at a boutique, because you have to have so many more of them, and it's hard to have that in-depth relationship into that person's business. But we all tend to have, 2 or 3 key relationships where you do have that visibility into right through the board and into the assets and that kind of thing. And that's why I think you tend to see those companies stick with those particular boutiques. It's hard to drive a wedge in between those lead relationships. So I think that's part of it. And then the grinding, I worked with, some guys that I could really see the benefit of just working hard, waking up every morning, having an idea, talking to people and that's frankly how you generate ideas. And this business is always morphing. It doesn't happen overnight. But to see those trends, and it's just hustle, it's no different than you're selling pipe or, anything else. You got to be a salesman, and you got to have relationships. And so you can't just throw shit at the wall and expect that to be useful. So, you have to be you're dealing with CFOs and CEOs all the time. And so you want to provide an idea that's of interest. And as a last bunch of years, as I've sat in more in the CEO side of things, I completely appreciate that when I love hearing an idea. I love hearing an idea that doesn't work. And, I feel like an investment banker is thinking about my business then. And so that's the way I tried to approach it, when I was in that seat, and making sure I knew what other companies were doing, what maybe it was something that was going on in the US. You gotta have an angle, and you gotta be, priming that pump all the time, making sure that you're the first call that CEO makes.
At the end of the day, Tristone was a business. You got to earn revenue somehow. Was there a tension at times between deal flow and quality deals, so to speak? Did you have to sacrifice? Or?
Sure. And more in the earlier days, yeah. Yeah, I mean, there is definitely an incentive to take anything that comes in the door, especially, like I said, when we've gone to the banks and levered up personally. It's really hard to say no to deals. And we had some good scraps about that for sure. And we said no. And our whole MO was that we were going to come at the market. We weren't going to be just another boutique, right? There's some other, and there's lots of them out there even today. But we wanted to come at it driving at a technical angle. And so we knew that we couldn't put a complete piece of crap on the table and say, yes, we're technical experts, and yes, you should buy some of this equity offering from this small company. It doesn't have to be a small one to be a bad one, but often they were. So yeah, we and sometimes you don't know, right? You can do all the work in the world and something just doesn't work out. Or commodity turns or what have you. But yeah, we fought that devil for sure, and tried to stay away from them. But yeah, there were some real donkeys that we ended up having to push. But as I say, I think we got away from that after probably the first year, once we kind of got our feet underneath us.
At the end of the day, management teams have long memories, on the other hand, and it's your reputation that you kind of have to lean on. So you can't peddle garbage. No,
and I don't think anybody does. Well, I'm sure there are some places that do it. It's just the knowing, right? Just, you're start playing and you're going back into early 2000s. So, there was more exploration focus on some of these companies. And so the risk was a lot higher, to be honest. There was a lot less manufacturing, multi-frac horizontal resource development. Today, it's harder to make that kind of mistake. And back then, I mean, a lot of the smaller companies were heavily focused on exploration. Today, you can grow. The more money you put out, the more you get back in production. I mean, it's more of a manufacturing operation. And back then, I mean, you would have 10 on the small side, 10 to 25% of your budget would be going to, I don't want to call them moon shots, but, exploratory shots. And, here's the old well log from the 50s that the guy, made a notation on the corner of. And, that was, there are lots of, ones that just didn't work out. But I wouldn't say that we certainly, and I'm sure most of the guys that I know in the business never pushed something that they knew to be crap. It's just, sometimes that pans out that way on small companies.
There's lots of opportunity in Canadian energy nowadays. Profits are basically a record high and whatnot. But back then there was so much opportunity in that seems like in that banking entrepreneurial world, you kind of miss those days in that sense.
Yeah, those were halcyon days. That was 05, 06, 07, right up to the financial crisis. It was often a deal a week, more than that actually, probably a couple of bought deals a week. And you always had private things on the go. Like it was just, we were closing deals left and right. It was great because the companies were succeeding and, everybody was benefiting. Everybody was happier. So yeah, it was a good time. It's very different market. The Canadian market even is very different from the US market. I've always had a lot more smaller junior public cos. They don't have that market. It doesn't exist there. From what I understand, it did it back in the 70s, but it was supplanted by the private equity world. So much larger private equity presence, larger private companies. And that's the cycle down there. Up here, have tended, back in those days, we were churning our assets at twice the pace that the US was churning them at. So more turnover means more fees for your investment bankers, as we all know. But there's distinctly a lack of that junior market now. And, consolidation into the, mid-cap is way larger than what we used to call mid-cap. Juniors, it's extraordinarily difficult to get the market's attention in the junior side of things. So, it will be interesting to see if it ever comes back. I think it may not. Again, some of that's just a function of the type of assets that we're pursuing now. You need to have the financial strength to be able to drill 8, 16 well multi-pad or multi-well pad. And that takes a lot of capital before you see that, turning into cash flow coming back. So to a certain extent, and just our well costs. I mean, we used to be able to, a $2.5 million exploratory well was not uncommon. And now it's pretty uncommon to see, multi-frac horizontal come in at, less than 6 or 8 mil.
Yeah. It's a lot of money.
It's a lot of money, but it comes with certainty, and it is easier. I mean, it's for someone like me who's not an engineer, not a geologist. This is a much better environment to do analysis in. It's much easier to put pen to paper. How do you risk exploratory play? And, you get into the personalities. Oh, this guy, he can find oil, he can't, or et cetera. So this is much more, you can see how guys drive efficiencies in the business. You can see what their return on that capital is actually going to be, to a pretty certain degree.
Mm-hmm. Do you remember when those days started to dry up, the multiple financings a week?
Well, they stopped on a heartbeat. They stopped when the credit crisis happened. Yeah. In 08, it hit everybody.
It was time to change.
Yeah. We ended up selling our business. It didn't really have anything to do with the credit crisis. We started having conversations with some of the larger players. So that our model worked. Like we grew like crazy. We were in, we had offices in Denver and Houston, London, England, and in Buenos Aires. We had a couple acquisitions we did, but yeah, we were growing, and the model obviously worked on the A&D and the technical side of things. So people quickly got over their concerns about conflicts of interests on the A&D side, which we never understood anyway. And so we started having conversations with a few different players, and that turned into a sale to Macquarie, and I think that was 09. So it was, I guess, near the end at that point in time.
Do you remember that day? You guys may not have to work again?
Yeah, we went, we weren't, you have mixed reactions, right? We weren't around for that long. It was kind of a 7-year run at Tristone. And, I think I speak for myself. I certainly had days where I thought we would be better off just continuing to push independently, and grow that way. We were talking to other partners that were similar kind of sized players in the US in particular, and in the UK a little bit. So there were different ways that we could have gone. And, the giant bank thing was, not particularly appealing post-transaction. We were a lot of people had come out of the banks and into that independent world. And the banks come with a lot of headaches for sure, just from regulatory restrictions to simply not being even able to trade your own account, from an investment side of things. So it was nice to be your own boss and not have that looking down on you after you've sort of gotten over that hump, the financial hump of being able to keep the lights on and being able to, make sure that your junior guys, had jobs, as they were creating their own families and that kind of thing.
You remember the time you realized this thing might work? This business is working. It's actually doing really well.
Yeah, I'd say the first year was a little touch and go, but probably before even the first year, like we really got traction out of the gate. We had our investors we had a pretty senior group of guys on our desk who had a bunch of relationships, and those relationships paid us right away. It was a little harder to get our competitors in town. And at that point, it was really just First Energy and Peters and Co. Obviously didn't want to share the pie. And so they fought hard. So we had some pretty tough battles on the corporate finance side in particular. But I'd say before the first year, we had an indication it was going to work. And I don't remember a day though. I think it's one of those slow morphing things. And, don't get me wrong. We want to kind of like the rich kid who's, hit a triple, or hit a home run, rather was born on third. We had the winds of the commodity cycle at our back. We started in 2002, and that's when things were just turning around, and we rode that cycle, and that helped us tremendously.
Mm-hmm. In a way that may not be possible today, although prices are strong. It seems like that kind of entrepreneurial banking niche it's just harder now.
Well, it's hard not even on the entrepreneurial side, but it's hard for the banks. A lot of guys my age that, like my friends that worked in for banks, aren't doing it anymore. There's just not a lot of business. I mean, part of that is the cycle that we're in. We don't see guys are being a lot more careful with the return of capital to their shareholders, and it's not all about growth. Since I entered the business, it was all about growth. So, we used to talk about, are you investing 100% of your cash flow or 200% of your cash flow? Now it's a small percentage of that cash flow. That's a vastly different, situation than it was back then. I'm not suggesting that it's a bad thing. It's a bad thing if you're an investment banker, but there's still, for the banks, they've still got very large transactions. There was a massive one with Ironbridge recently, and, that'll feed a lot of mouths for a long time on the banking side of things. But yeah, this is a different world now where growth is not the end destination, but it's, how do you get money back to shareholders? Are you either buying back stock or you're dividending out cash flow? So,
well, before we touch on Tidewater, maybe a couple questions from the fans on Twitter. Biggest lesson you took away from the Ironbridge deal?
Biggest lesson, I think. Well, a kind of specific one was with regard to the Montney. So I thought that the wells that we were targeting, while they worked, we had, good drilling results. They were more variable than I had thought. That's maybe a little bit more specific to the area. We were in a normally or slightly under pressured, part of the Montney that was very, oily and, had lots of water. So there were a lot of things to deal with. So I guess I learned a lot from the technical side of that situation, that area. a lot of the variability that goes into an individual well. It was the first time I had run an E&P company, first time I'd worked in an E&P company as opposed to just providing advice to them. So I think that was the technical side was made you think twice about making really good, projections on single well economics and things like that because of the variability. But yeah, we ended up in a hostile takeover pretty quickly, so we didn't really get to do a lot. We had a really good asset sale. We sold some assets at good value, and we didn't see very much upside in those assets. So that was, a great way to beef up the balance sheet and prepare to develop our focus, which was up in Gold Creek area. But yeah, that was probably the biggest lesson. There were some personnel lessons that I learned. I changed out that whole team, and that was right out of the gate. That was by design, and brought in a new team. So that was interesting. And
in terms of Midstream and Tidewater, what to you makes a good midstream company?
Well, it's not that different than any other business. Providing good service to our customers is really important. So that's all the way from commercial, which is people tend to think about that as being, touch points with customers, but really understanding what the customers want. And that is reliability, value for the service that you're providing, competitive, let's say processing fee, if let's say it's a gas plant. But providing good service means that you're got really good reliability. You're not having unplanned outages and things like that. So you're really working hand in glove on the operations side with those customers and making sure, when they're bringing wells on that we can handle it. And so just being focused on what our customers are focused on, which is throughput and, ultimately for them, cash flow. Reliability is crucial. And that's, one of the key things, a new customer into your facility will ask you about.
Mm-hmm. It's, kind of a paradox in the midstream sector in a way where it's difficult to grow nowadays. And so it makes the assets valuable, but how does Tidewater grow? What's the growth mechanism for the company? What's the catalyst?
Yeah. And it's, something we discuss a lot, especially since I've come in here. We talk about growth, especially in this industry, a lot. Growth you can grow and destroy value. Growth does not come with creating shareholder value by itself. So that's the first thing. We've got good assets. After we just did a sale of our Pipestone gas plant, which was very sought after, as well as Dimsdale gas storage facility. I think it was, it happened at multiples above the multiple that we trade at. So we were in a bit of a box. Once you've lost your cost of capital, it's very hard to get that back. So that makes it very hard to compete with companies that are many, many times larger than us and have a much lower cost of capital. They can afford to build assets and take lower returns on those assets. Same thing when you're competing on purchasing something. So we need to focus those assets. Pipestone, it was great that Tidewater guys targeted the Montney early, and they got in there early. But those situations are so rare that you can't count on building a business based on those. That should have been a plant that was owned by any one of the large players. It's right in the heart of where all the activity is, where the LNG is going to go. It's a very active, busy area, and every large midstream company needs to be in there. We don't need to be in there. We made good money off of those, selling those assets. But when we look at our opportunities, they tend to be around our assets that we're currently operating, assets that simply wouldn't make a lot of sense for a larger competitor to own. And there are a bunch of those types of opportunities. Some of them are building connectivity between facilities. Some of them are, being able to source some of our feedstock for the refinery from some of our fracking operations at, one of the gas plants. So seeing how those assets can work together is probably more important to us than, looking for some white elephant that we're going to build greenfield again.
What separates a good midstream company? Is it technical knowledge or good capital allocation? A bit of both? Is it buying on the low part of the cycle? Maybe all of the above?
I think I'd go with all of the above. Remember, I would just say it's you got to differentiate the big cap guys, the AltaGas, Pembina's, Keyera's, even into the Enbridge and TC Energies. I mean, those guys, they're already established. They've got a large footprint, and, optimizing that footprint and creating value for their customers is important. Midstream companies and E&Ps haven't always worked together. And Joel McLeod, who started Tidewater, I think he recognized that, and he recognized that there was room for a company that could be very customer focused and working with. There's a very combative relationship oftentimes between midstreamers and producers, in that midstreamers just are trying to drive processing fees, trying to maximize what they can out of things. And the bigger you get, whether you're in the banking world or whether you're in the midstream world, the bigger you get, the more processes you have to have, the more more regulations, the more, you just have to have rules that your teams need to follow. When you're smaller, you can be more flexible. You can do one-off situations for a producer. You can help that way. So I just would differentiate between the large guys and the smaller guys. The smaller guys have to do something unique. In our case, it's that customer focus. And other guys might be focused in a particular small area that a big guy isn't going to want to come into. So there's different strategies, and I wouldn't say one is necessarily more obviously successful than another.
The cost of capital has been tough in Canadian energy the last 10 years. Is that, in a way, it's forced companies to live on profits and cash flow? Have you found it to be a good thing for the midstream business, or is it made life difficult?
Yeah, I mean, volume growth is positive for midstream companies, right? The more volume growth you have, somebody's got to process it, right? The other way is very nasty because you get plants that are, you lose efficiencies as your throughput drops below your nameplate capacity. So you want to try and optimize your pots and pans. You want to put as much volume through as you can. I think it's been what we've been in since the COVID, and it's come with low multiples. That's the negative part is, I don't think that investors are valuing what our E&P company, let's focus on E&P because it all flows after E&P, it all flows, whether it's midstream or service or anything else. It starts with the E&P companies. I think they are undervalued, but that is forcing them to deal with it by either distributing that cash flow or paying down debt, which most of them focus on paying down debt, or share buybacks. That is important because this industry has had a bad reputation historically, and I mean historically like 30, 40 years, have destroyed shareholder value over time. And that's because they've been focused on growing at all costs. That's great while the commodity is in your favor, but as soon as it turns the other way, you've destroyed a lot of value, added a bunch of debt, all of a sudden you're chopping staff, it drives those ups and downs. And that's, the boom bust cycles that, Calgary as a city and Edmonton as a city or province even, has lived with. Those boom bust cycles are because of that focus on growth at all costs and valuing the guy who grows faster. Now, I would be willing to suggest that we will see less of that boom and bust cycle because I think guys will keep their balance sheets, which are, you can only call them pristine today. I think they'll keep those pristine. And I think that there will be more of a focus on return of capital to shareholders. And that ultimately, I think we're going to get out of that historical, you talk to the old timers on Bay Street and they'll tell you, yeah, it works once in one year in 4, et cetera, et cetera. But I think we have a much more sustainable model now.
to touch on the positive attributes of Tidewater. You may not have the number off the top of your head, but what does Tidewater give back to the local economy in terms of, just to stay flat?
Well, a lot. We may own a gas plant, and that gas plant's nameplate capacity doesn't change year to year. We certainly have maintenance capital that we have to spend. There's that maintenance capital, which is ongoing all the time. We had a turnaround this year at PGR, our refinery in Prince George, which happens once every 4 years. That's $60 million that's spent in that local economy just on that turnaround. We have ongoing turnarounds more frequently in the gas plant side of things, but we would be spending $60 million a year just on maintenance capital. But we've always got at least one project on the go. We own 69% of the renewables business, and we're just about to bring on Canada's first renewable diesel facility up at Prince George. That's a $400 million investment. It's not all in the local economy in Prince George. Almost all of the pots and pans that are associated with that HDRD, the renewable diesel plant, came from Alberta, some overseas, some in the US, all over the place, but all of it was assembled. We had almost 1 million man hours of construction that happened there. So yeah, we're a big part of a variety. We're a very large part of the Prince George economy. I'd say we're probably the largest company in that market. And then wherever we've got gas plants, they don't tend to be in cities or towns, but we support smaller communities that, exist around, whether it's Drayton Valleys or any number of the places around our assets.
The underappreciated nature of industrial development, the contributions that it makes to the economy.
Yeah, it's everywhere, and it's not, I think it's helpful that it's not concentrated in downtowns of cities. We've got nearly 500 people. We've got 125 here in the head office. The rest are, working generally in relatively small towns, or sometimes in the bush, depending, especially Pipestone was very much in the bush.
Tidewater, the future going forward, what do you see as the opportunity for the company? Is it the renewables? Is it optimizing the existing assets? Where does the company go from here?
Yeah, I think those are both, there are assets that we're looking at, both building as well as purchasing around our current assets, but they're much smaller deals than have been done in the past, and they will be immediately cash flowing and those kinds of things. Optimization stuff that we really haven't had the balance sheet to be able to do. So stuff that's been wanting to do but not been able to do because we've had too many of these large projects, and frankly, we were sitting on way too much debt. So with the asset sale, once that closes, we will have very little debt in Tidewater Midstream. And as I said, we're going to have that renewable diesel plant up and running. We're hoping even this week, and that's going to generate a significant amount of cash flow, which we will pay down some debt in the renewables entity, but that entity also has a number of growth opportunities in front of it. So there are sustainable aviation fuel opportunities. The BC government has been a great partner to us there, very much encouraging us to continue to build more renewable fuels projects. We've got an RNG project in High River, renewable natural gas. It's fed off of manure down from a feedlot that we own half of. So we've got a number of projects there that will be, I think renewables is a bit more of a growthy entity. There are a lot of interested parties on that side of the business. There's both financial as well as some very large companies that are, see that as being a great opportunity. There's a very small handful of renewable diesel facilities. And I say renewable diesel, I don't mean, people confuse it with biodiesel, but this is renewable diesel, which is stuff that you could drop right into your tank. That's sort of the future of the diesel, renewable diesel world. And aviation fuel is sort of the next one to happen. But yeah, there are a whole bunch of larger companies that are quite interested in getting more involved in that space. And we're having a lot of discussions with those types of folks. Those might be partnering opportunities. They might be more than that.
On the flip side, what keeps you up at night? What do you worry about?
Yeah, I worry a lot, probably more than I should. You worry about everything. The first and foremost is, especially when you're a bigger company like this, similar to what I had when I was actually running the service company there and here. I worry about getting a phone call in the middle of the night and somebody's hurt themselves badly. I mean, we have people dealing with dangerous situations. And, operating let's say a sour gas plant has its own operational risks, but we've got construction projects on the go. And like you said, we had up to 700 people working on a very small site up in Prince George through this HDRD build. It's really, really easy to get hurt, by mistake, even if you're paying attention. Like, even if these aren't people that are
sitting at home.
Yeah. Or just, it's not a mistake, or it's not not paying attention. It can be, a failure of some piece of equipment or something. So anyway, that's always in the back of your mind. Then, we came into, when I took this company over, financially, it was in tough shape. So there have been a lot of periods of worrying about the finances, especially as we're doing a very large build on the one hand, and we've been going through this process. And so anytime you go through a large transaction, as we did, and negotiating with the counterparties, and, the deal's on one day, it's off the next day, and, that generates its own set of concerns. So there's lots to worry about. Yeah. Never short of anything.
Well, that is a great conversation, Willis.
Enjoyed it.
We can more or less end there. If you were to leave the shareholder with a message, maybe to wrap things up, what might you leave them with?
Well, we're very close to generating some real demonstrable shareholder value. And I know that certain investors have been with us for a long time. And I recognize that it's time to reward those shareholders, and think that we're well on our way, even in the very short term of, being able to do that.
That's it.
Thanks, Trevor.
Thanks for listening, everyone. Hopefully you enjoyed the episode. If you liked what you heard, check out roadsbros.ca, where we will have upcoming shows. Until next time, happy coffee drinking.